Imagine you are planning a mountain trek. You can either prepare yourself in one go by taking a week off from work to train intensively for the trek, or follow a daily exercise routine to gradually build up your stamina for the trek. This explains SIP and lump sum techniques of investing. Hello everyone, welcome to our channel 5 Minute Finance. In today's video, we are going to discuss what SIP is, how it works, its benefits, and how it is different from a lump sum. So, let's begin. Just like exercising daily to build endurance for the trek, SIP is a slow and steady method of investing where you take gradual, small, and regular steps to build wealth over time. Whereas, when we invest a specific amount of money in mutual funds in one go, just like extensively training for the trek in a week, that is known as lump sum investment. So, SIP is a wonderful way for every investor to invest any amount, small or big, in a planned manner in mutual funds. You may start your SIP with 500 rupees or 5,000 rupees or 10,000 rupees or 10 lakh rupees or any amount as per your choice. But the condition is you should not stop. Now, if you don't know what a mutual fund is, you may check another video on our channel to understand the mutual funds first. You can find the video link in the description below. Moving back to the SIPs. So, SIPs allow you to invest at your own pace. You may select daily, weekly, monthly, or quarterly time periods to invest. Now let's move to understand how SIPs work. So, when you start an SIP, you choose a mutual fund scheme and a fixed amount that you want to invest regularly, say every month. Your bank transfers this amount every month on a specific date to the selected mutual fund scheme. In turn, mutual funds allot you some units of the fund. The number of units will depend on the price of the fund on that date. Hope you have understood how SIP works. Now let's move on to see how investing via SIP benefits an investor. So, when you invest via SIP, you take steady and disciplined steps to investing. SIPs help you to take advantage of market ups and downs. So, when the stock market is up, you get lesser units, and when the market is down, you get more units of mutual funds for the same price. When you invest monthly via SIPs, obviously you'll buy the same mutual fund at different prices. So, keeping it simple for the explanation purpose, let's take another example. Let's see what happens when you buy apples worth 1000 rupees for 5 days in a row. So, on day 1, the price of apples is 200 rupees per kg. You could buy 5 kgs of apples. Assume next day the price of apples fell to 150 rupees per kg. So, you could get 6.7 kgs of apples. On the third day, the price of apples jumped to 230 rupees per kg. So, you got 4.3 kgs of apples. On day 4, the price of apples fell again to 185 rupees. So, you got 5.4 kgs of apples. On day 5, the price of apples rose to 225 rupees per kg. So, you got only 4.4 kgs of apples. So, what has happened here? When the apples were available at a discounted price, you could get more apples for the same price of 1000 rupees. And when the apple price shot up, you got fewer apples for the same money. This regular buying also lowered the average cost of buying apples. So, we bought apples at an average price of 193 rupees per kg, which is way lower than the current price of apples, which is 225 rupees per kg. SIPs work in a similar way. You invest the same amount every month. So, when the price of a mutual fund is up, you get lesser units. But when the price of the mutual fund is down, you get more units of mutual funds. And when you continue your SIPs for a longer period, your average purchase price to buy 1 unit of mutual fund averages down. So, when the market rises, the lower purchase price achieved via SIPs translates into higher returns. By now, you must be clear with the concept of SIP in mutual funds. So what are you waiting for? Don't let your money sit idle in banks. Invest lump sum or start investing via SIP on the ET Money app today. With this, we have come to the end of this video. If you found this video useful, please like and subscribe to our channel and share this video with others as well. We'll see you with another insightful video soon.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.